Hello, I'm Jason Kelly. Thank you for joining me today. In this video, I'll look at whether stock prices are too high and therefore likely to crash. Pundits who are bearish frequently say the stock market is overvalued. What does this mean? Usually it means that prices today, as compared to some other measurement, are much higher than they've been in the past, and therefore hinting that they may be poised for a crash. For example, a lot of times prices will be compared to earnings levels or sales or even to the gross domestic product of the United States to see if maybe prices are getting ahead of business results. Recently, CNBC looked at this last measure, which was stock valuation as a percentage of GDP, with the headline, "By this measure, stocks are massively overvalued." There's an attention getter for you. They show the chart there of the Wilshire 5000 market value compared to GDP. You can see it coming down into the early 70s, going sideways for a while, and then escalating past the crash of 2000, the dot-com crash, and then you can see them coming down again in the 2008 crash. Below the chart, the text reads, "Market valuation can be measured in many ways, but one comparison of equity valuation to economic output yields a troubling conclusion. Right now, the total market cap of the Wilshire 5000 index as a percentage of U.S. gross domestic product is about 120%, far above the 45-year average of 75%. To some, this indicates that stocks are priced too richly and hence may not be a good buy at these levels." Sometimes it's a combination of factors, as explained by John Huston recently in his March 6, 2017 commentary titled "The Most Broadly Overvalued Moment in Market History." He starts off by saying that the consensus of the most reliable equity market valuation measures we identify, those most tightly correlated with actual subsequent S&P 500 total returns, etc., etc. Now down to the highlight. Now, before I go to the highlight, notice he's looking at a combination of valuation factors, not just one. At the bottom in the highlight, he says, "The valuation of the median component of the S&P 500 is already far beyond the median valuations observed at the peaks of 2000, 2007, and prior market cycles, while our estimate for 10 to 12-year returns on a conventional 60-30-10 mix of stocks, bonds, and T-bills fell to a record low last week, making this the most broadly overvalued moment in market history." What's the purpose of such observations? It's a worthwhile question, isn't it? The purpose should be to indicate that stock prices are too high and therefore ready to crash. Because if they're high but going higher, why would we care? If they're high going lower, then it could be useful to us because we could sell ahead of that and avoid the crash. And this is how it's always presented. Stocks are too high, they're going to crash. The question is this reliable? No, it's not, because sometimes these measures are right and sometimes they're wrong, making them just like the rest of these indications in the 50% unreliable coin toss environment of the stock market. Let's go back to that CNBC chart of market cap to GDP. Notice that the straight line shows the long-term average of the measurement, where it's almost never at. It's never at average. So we can almost never say it's right where it should be. It's either below that, presumably indicating a good time to buy, or above that average, indicating a good time to sell. Has it been a good time to sell when it was above that, or a good time to buy when it was below? Not really. It's pretty spotty. Compare that chart with the S&P 500 since 1996. Notice a few things as we compare these two. There was no overvaluation of the stock market cap as a percentage of GDP as we headed into the dot-com crash. None. It looked perfectly fine, right at average or a little below average heading into this, and there was no red alarm there saying to sell by this measurement. Then notice that it was rising as stocks fell after the crash. But what would have been the right thing to do at that moment? Buy into stocks. As prices were coming down, you had better bargains for the recovery that was going to follow. Then in 2008, with the subprime mortgage crash, this measurement did go down. So somebody might say, see, look at that. It was going down as stocks were crashing, indicating a good time to buy. Right, but if it's going down exactly with stock prices, how useful is that? I would argue that by just watching stock prices go down, you'd have a pretty good indication that, guess what? Stock prices are going down. Similarly, it was rising with stocks since 2009. We had a wonderful recovery, right? Notice on the chart, this measurement was also rising with stocks. You could look at that and say, see, it's showing that stock prices are getting too high. Not really. It's showing that stock prices are rising, which again, you would know by just watching stock prices. So what? There's no usable pattern here. This is the problem. How about Huston's ominous sounding warning? Remember the most overvalued market? He doesn't share his valuation measurements, just calling them the most reliable ones he identifies. But are they reliable? Well, not recently. Here's an excerpt from this year's Kelly Letter Note 11 sent to subscribers on March 19th, 2017. This is Huston's recent history. It reads from the letter, Huston's latest warning is grim and convincing, yet we find in Huston's archive of past missives the following titles. October 10th, 2016, Overvaluation, Deteriorating Market Action, and Coordinated Exit. That's the headline. April 11th, 2016, Rounding the Bubble's Edge. January 4th, 2016, The Next Big Short, the third crest of a rolling tsunami. April 27th, 2015, Fair value on the S&P 500 has 3 digits. January 16th, 2015, Extreme Overvaluation and the Inventory Problem. July 28th, 2014, Yes, this is an equity bubble. Huston's obsession with overvaluation and propensity to see bubbles that don't pop has cost his followers. Here's what the S&P 500 has returned after each of the above warnings through March 17th, 2017. Up 11.5% from overvaluation. Up 16.2% from the bubble's edge. Up 16.4% from the next big short. Up 12.3% from fair value. Up 16.3% from extreme overvaluation. Up 20.2% from this is an equity bubble. Stock market valuation measurements are not reliable. That's the bottom line. They're sometimes right and sometimes wrong. The market can keep rising past where people think it's overvalued, and it can keep falling past where everybody agrees it's cheap and should be bought. Since there's no reliable conclusion to draw from any of this, it's pointless to look at it. I never look at valuation, and I suggest you adopt that approach in your own investing portfolio. Nobody knows whether prices are too high ever, or frankly, what that notion even means. Thank you for watching. I hope this has been helpful to you. Non-Kelly Letter subscribers, I hope to see you on the list. And current Kelly Letter subscribers, I will see you Sunday morning. Thank you again for watching.